Hello friends, this is Raj Sastry from Raj Option Trading. Today I want to talk about one of my favorite companies. It's DermTech, ticker symbol DMTK. So today is April 19th, 2021. So this is into, skin cancer diagnostics, and this company has got a neat patch as you can see here, and this can help to detect skin cancer pretty easily. You don't need to go through the biopsies. This is a simple solution to detect skin cancer pretty accurately. So with that, skin cancer, market is a, very much growing area. Compounded annual growth is 10.4%. So, this is a very good area, and this company clearly wants to become the leader in the skin cancer diagnostics area. So with that, let's jump in here. And this company's mission is to transform dermatology with the non-invasive skin genomics platform. So as you can see here, there's a picture of their platform here. That this is how they detect. And this is a clear leader in the precision dermatology enabled by non-invasive skin genomics. And they address a large market of opportunities in skin disease, and they're into commercial stage at this time. They got this PLA for early melanoma detection, and they're also accredited as you can see here. And overall I feel they're doing pretty nicely. And let's jump in into this to see what their solution does. So in the good old days, you got to look at the skin cancer, visually, and you got to order a biopsy, and then you got to really look through and look through the microscope. But if you look at this, it's very invasive, very subjective, low accuracy, high cost. From this low accuracy, high cost, this company wants to go into non-invasive. You just put the patch and you basically diagnose it, and it's really high accuracy and low cost. So with this simple patch, more people are inclined to test for skin cancer versus good old way of a biopsy. So that's why more and more clinicians are ordering for this non-invasive patch, so you can easily detect the skin cancer. So there is no pain for the customer. It's pretty easy procedure. So with that, if you look at the skin cancer market in the US, 1 in 5 Americans will develop skin cancer by the age of 70. That's a huge number. There could be various reasons. It could be ultraviolet rays, could be skin damage, a lot of reasons. So with that, there is also the cost of treatment is very high, but this procedure, with a simple patch, we can reduce it drastically. So this company is really, making sure people get detected early and they can live longer. So with that, if you look at the company's chart here and profile, it's really, they want to be clear leader in the non-invasive genomic tests, and the stock price is around $37. Market cap is $1.07 billion. As you can see the stock chart here, since last year the company has done very nicely, and since maybe December or so the stock has spiked up so drastically as you can see here. Now they're taking a breather. It's very understandable. Company with such a huge spike, they have to take some breather and then make the next leg. So with that, good revenue here, 5.88 million, nice revenue growth, 33.50%, good amount of cash, very low debt. Operating cash and delivered cash flow both are negative right now. It's very much in tune with the growing companies. And the CEO John Dobok, he's a seasoned leader. He was in the life sciences business, he was in the healthcare business, he was doing endovascular, and he was also doing cardiac arrest type treatments. I mean, he has been in the healthcare area for a long time. And from a news perspective, DermTech joins Skin Cancer Foundation, and they're also one of the top stocks in the Motley Fool, and they're one of the beaten down stocks right now. And there are good study talking about the cost savings by their PLA procedure. So with that, overall, I feel good about this company. Stock has fallen down. Let's jump in and see it's a good time to buy. So with that, if you look at the quick statistics here, looks like in January, Oppenheimer upgraded the stock with the rating of price of 53, and they've been making positive progress on the earnings per share. It's improving, as you can see here, and the sales is really nice sales growth. As you can see here, nice sales growth here. Shares outstanding, I think it increased in 2020, but hopefully they can manage it closely and reduce it a little bit. So with that, if you look at the competition here, we got number one performer, which is Pulse Biosciences, 218% in 1 year, and next is the DermTech. I love DermTech's sales and also sales growth 1 year, sales growth quarter to quarter. I mean, this is the best in this competition list here. And they've done nicely for the year, 203% over 1 year. And then we got Castle, iCAD, Strata, and Census. I like iCAD here, nice sales growth quarter over quarter. And also I like Castle because they got at least positive sales growth here. Only one thing I don't love too much about DermTech is their high valuation. They are 100 plus next year sales from a valuation perspective. That is a little bit high. So with that, let's jump in here. If you look at the fundamentals here, company has done nicely. Their stock price is currently $37. Market cap is 1.07 billion. And if you look at the market cap, they have improved the market cap nicely over the last couple of quarters. On 9/30/2020, it was $234 million, and they jumped to $932 million. Now it's $1.07 billion, even with this drop. And from a price perspective, they've been doing very nicely. $11 back in 9/30, $32 in 12/31, 37 now. I love their sales growth here, even though it's from a lower base. It's a nice sales growth, 33% year over quarter over quarter. And the revenue surprise, they've been surprising Wall Street with a positive revenue surprise, which is nice. And EPS, earnings per share, also there is a positive surprise here. And gross margin is positive, and net margin is negative. They're still not making money right now. That's why it's negative, which is understandable. Very early stage company. Price to sales is a little expensive at this point. I think this is one red flag for this company, high valuation, which typically happens in the early stage companies with a rapid growth. And from a projection perspective, the company says they're confident they will continue to make progress with the adoption and grow their business. And from a estimation perspective, they think their revenue in Q1 2021 will be around 1.6 to 1.9 million. So this is where they're giving a little bit lower estimation. Right now it's making $2 million. Now they're saying 1.6 to 1.9. So I think if you think through this, I think you have to be a little. I think if you compare it to their previous quarterly statement, I think they're still okay. So if you really compare it to maybe 1231 here, 331, so they've done $2 million in 320. So I think they're giving a little bit lower projection here. That's one of the reason Wall Street probably not liking it too much, because they're guiding a little bit lower with calling out some COVID related decline. Mainly these doctors and patients are not going to hospitals as much, so they're showing a little bit tepid sales growth here. So with that, let's jump in. If you look at the company's earnings here, couple of quick points. I will not drain through this slide. The revenue increased 33%, which is very good, and they had a nice sequential increase here, which is also good. And billable samples increased 75%. Medicare portion increased by 1%, and clinicians ordering I think there are a lot of clinicians ordering this, this samples, which is also good. Next, on the negative side, looks like there's some of their sales ramp trajectory has reduced a little bit because of COVID. They are only 20 to 30% of pre-pandemic levels. And looks like their contract revenue decreased by 49%. Again, COVID related impact, and decrease in gross margin driven by higher contract revenue, and also higher payroll related costs. I think these are some negative. On the positive side, I feel like they're doubling down on the R&D, which is really nice, because this type of company got to increase their R&D to outcompete the competition. That's the good news here. So with that, if you look at performance perspective, I like this. Very nice. They've been doing 4%, 21%, 161% in 2020, 33% in 2021 so far. So there is not too much negative here. Stock is doing nicely over the years. On a monthly basis, as you can see here, this stock has ups and downs. I would say more ups than downs, but as you can see, a steep down 73% and bounced back very nicely, and steep down here 19%, bounced back nicely. Now 2 consecutive months, 23% down, 14% down. Looking at the history of this company, I can see this company bouncing back. This is really, because of high valuation, little bit lower guidance. That's why stock is dropping off at this point. And on a daily basis, weekly basis, if you see here, company has been, 3 weeks continuously dropped, then, increased again, dropped. This is a huge drop here, 16%, 27%, bounced back, dropped again. I think it's for this stock, which is a highly volatile type stock, you can expect the price to bounce back and forth. I think it's normal for this type of company. And if you look at the daily performance, I think as it's all over the map, more red than green, which is understandable because sometimes there is a market rotation. People want to go out of growth into value play. I think this stock is being impacted by such moves. And let's now look at monthly performance matrix. The way to read this chart, I got years 2021, 2020, 2019, and I got the months here. The reason I bring this chart up is really to see if there is any pattern that we can spot here. By looking at this very quickly, I don't see significant pattern, but you can see here they dropped in 2020 around Jan, Feb, March time frame. Now they dropped March, April time frame. Somewhere in this patch here, first 4 months of the year, you can expect some drop. Then they got some drops probably in the July, August time frame, as you can see here. From there, I think it's a smooth sail for this company. So I would buy this company on the dip like this, buy a little bit and add to your position if it drops further. So that way, you can dollar cost average. Overall, this company will do well. You got to have some patience. I would not recommend buying any call option because with the call option, if the company drops or the price stays the same, you might lose money with your call options. It's good to buy the company stock versus call option at this point. If you look at inside trading history here, the CEO, uh, John Dabak, looks like he sold shares worth $1.1 million just a couple days ago, 12th of April. This could be one of the reasons why people think, what, CEO himself sold a lot of stock, there could be something going on. But I think this is very normal for CEOs to sell some of their options and stocks because they have accumulated so much. And as you can see here, I think in the in January, one of the person here, 10% owner bought a lot of shares, 5.9 million, which is good. So overall, I don't see any negatives here. It's a normal course of CEO selling some of his holdings, which is understandable. And if you look at the technical perspective, nice looking chart here. They've done very nicely, as you can see here. Now they are below their 9-day, 25-day, 50-day moving average. Um, and I think stock is kind of coming down here. They got earnings coming up in 13 days. And if you look at the last earning, they kind of dropped a little bit, then went up. Now they are here. So, typically when the company goes up before the earnings like this, you can expect a drop at times because it shot up so much. But now we are here, companies has dropped so much before the earnings. I feel there's a good chance that this company can do well after the earnings. And from a RSI relative strength index perspective, it's at 43. Typically, around this level, you could start buying. It's a good entry point. And from an implied wall perspective, implied wall is relatively low here, 53.1. I mean, it's even though it's lower than historic volatility, I would not buy call option. It's still higher. 53.1 is higher. I would wait to buy call option. I want to see it below 50. And from a DMI perspective, as you can see here, red line is above blue line, which is negative. Right now it's bearish. And on the balance volume perspective, it's dropping off a little bit, which is not a great sign. And check in money flow perspective, money is flowing out of the stock at this point. So what I would do is really, right now, because stock is falling, it's normal to see chart bit ugly. I would, probably start buying slowly here as it drops, add to your position, so accumulate some position. So as the earnings comes up, you can get a nice pop in this stock. Because stock has fallen down so much, it's doing nicely. It can surprise the Wall Street. From a option chain perspective, now stock is at $37, as you can see here. And if you look at the options here, around 35.88 here, open positions. And as you can see here, there is as you go to 40, 45, 50, there is a lot more open position here, which is a bullish indication that people are positive. They're buying call option, even out of the money call options. And if you look at the put side of the house, I think there is some volume, but not huge. I would think. On the call side, you got more volume here. On the put side, it's relatively low compared to call volume. So that's a bullish indication. And next, let's look at today's option statistics in Thinkorswim. And as you can see, your call volume is much more compared to put volume. That makes the put call ratio as 0.13. So that indicates people are buying the calls. They're bullish on the stock, even though stock has fallen down. So I think from a sentiment perspective, people are bullish on this, even though it's fallen down right now. So now what should you do? DermTech, it's fallen down so much. What should you do? As you can see here, DermTech is a clear leader in this category of medicine referred to as precision dermatology. With the early penetration, melanoma can be cured 99%. This is why more and more doctors are ordering for this detection, this diagnosis. And company expects to expand their dermatology sales. They're adding more salespeople. That will increase their sales. And they're also working with multiple prominent networks. This is a good story because that will increase their sales. And they're also going after the telemedicine offering. I think this company realized you got to do telemedicine, otherwise you can't depend on people showing up in the hospital with this COVID going on. I think that's a good good way of thinking. And they have been making significant advancements, and they want to do they have good pipeline in the skin cancer products, and they're also looking at other areas like inflammatory diseases. Valuation is a little bit high, that's why it's a little red flag on the valuation side of the house. But with the stock, doing very nicely, high growth type stock, I think, it's understandable. But, I feel the stock is oversold. I think it's a very good buying opportunity. Only thing is you got to buy a little slowly, so that way you don't buy large quantity at once. I would say, buy slowly. If it comes down, buy more. That's how you accumulate, this type of stock. So with that, thank you very much. Happy investing.